Hello everyone, welcome back to my lecture. So in our last lecture we spoke about investment and savings curve quite in details, and there we tried to show you the relationship between rate of interest and total output in the product market. And there we had drawn investment and savings, which is popularly known as ICE curve, and how ICE curve is getting formulated from other major components in the aggregate function, which is basically from consumptions and from consumptions it is savings. So we dealt savings function, and from savings we also got the equilibrium conditions where savings equals to investment, and then we also had brought investment and rate of interest functions, where we had shown that investment function is downward sloping. This is primarily because of the rate of interest and investment, they are inversely or negatively related. And then combining these three functional relationship, then we got the ICE curve and then also ICE equations. So now moving forward with the other very important markets, and that is monetary money market, and then the policy that are related to money market is basically monetary policy. So we'll be talking about these 2 points, and then we'll also discuss in this lecture that how IS and LM, these two are interact with each other, and then how it changes in the equilibrium conditions. So to begin with, in the money market, so let us understand the money supply. So of course the primary concepts that we are discussing here is in any of the markets, and those are demand and the supply. So in money market, obviously demand for money and supply of money will be discussed. So what is supply of money? So real amount of the money supply will be given by MS by P. P is the aggregate price level, and MS is the overall money supply that is injected by the central bank. And in case of India, for instance, central bank is RBI. So MS is the total money supply which will be injected by the RBI in case of India. So when we are talking about real money supply, is getting reflected with the money supply by general price level. So now what is the demand for money? So demand for money, that is the what it is very important, because this is what consumption behavior, citizens behavior, investment behaviors all actually comes, because that's how money will be demanded, and based on that money supply, theoretically speaking, that money supply will be supplied. There are 3 motives that money gets demanded. So one is transaction purposes, like transaction demand. So when people demand more money for doing transactions, for transaction purposes, like for more goods and to buy goods and services, then they require money. If there is a demand for more goods and services, then obviously demand for money also will be increased, so the higher output. So this is one way. So by the same logic, we can say that when transaction reduces, then demand for money also will reduce. So this is proportionate relationship between transaction and money demand. So higher output if there is a demand for more money, and then higher demand for finally higher demand for money. So higher transaction means higher output, and for higher output there will be a higher demand for transaction, and thereby more demand for money will be there. So precautionary motive is very simple, like some of the activities for some of the accidental or adverse events, that there is always possibility that there will be sudden unspeculated demand for money, which we can refer as precautionary demand for money. So that due to precautionary motive, there will be rise in the demand for the money. The most important, which is very dynamic in nature, and that is speculative demand for money. So it depends on the rate of interest that financial institutions like bank that they look at. So higher the rate of interest, lower the real money for demand. So that is very obvious, and that we already discussed in our previous discussion with regard to ICE curve. But here also from money markets point of view, if rate of interest very high, then certainly cost of borrowing or cost of money will be high, and then there will be lower demand for the real money. So this is what the most important. So now precautionary demand for money can be, here there are two factors of course. So precautionary demand for money, one can say that this is a liquidity, like this is the cash, main cash. So here we can see like from speculative demand for money. So here money demand is a function of say rate of interest, and from transaction demand for money, so money demand is actually going or is a function of total transaction, and total transaction is giving the total output, and therefore here money demand is a function of positively related and function of total output. So money demand is the money overall, if we combine like all demand for money, like if we say like we can say here it's like speculative and this is for say transaction. So overall demand for money, we can say transaction demand for money plus speculative demand for money plus precautionary demand for money. So for precautionary demand for money, it is fixed, and therefore for transaction demand for money, we can say like function of income. Just for simplicity, we can show, and that is speculative demand for money is a function of say I, and precautionary demand for money, which is not depending on the market, not also depending on the transactions, let's say it is constant. So for simple understanding that overall, if we consider this as a liquidity, like for the liquidity purposes, what amount of money that we require and how they are related to which factors. So here L represents as liquidity, and then it is a function of total output, which is for the transaction purposes, and small I, which is the rate of interest for the speculative demand for money. Therefore overall total money demand function can be written as MD equals to L, Y and I in the money market. So then what is a money market equilibrium? So for any point that we need equilibrium conditions, and here in the money market there is also money market equilibrium conditions, and here money demand will be equals to money supply. So here money supply, as we already know, it is the real money supply, which is MS by P is equals to L. L is a function like liquidity function, which is depending on Y and I. Y is transaction like total output, and I is the rate of interest. So we can give this as equation 1, like grand equation for the money market. So this is what money market it looks like. So now let's one can also say that this is LM curve equations. LM is liquidity, and then L is coming from liquidity, M is coming from money supply, and liquidity is basically coming from money demand, and M is coming from money supply. So LM, when we are calling it LM curve, it is actually showing the equilibrium conditions in the money market from both from money demand and money supply. So let's move further, just the way we had discussed about the ICE curve. So now let us also understand LM curve from the LM equations. So by definition, LM curve shows all the combinations of real rate of interest, which is adjusted like real rate of interest, and income, real income, which brings the money supply equals to money demand. So for the aim is here, the aim is not to show you all the details about the LM curve. The aim and the intention is to take you through all the technical details of the LM curve, and aim is to show you where is the policy level interventions and policy level discussion, and that's how we will show LM curve. So let's again take the 4-panel example, like say income measured on the along with the horizontal axis in panel A, and then here say for the transaction purpose. I'm not getting into all the details, technical, all the details, but then just to show you here just a functional relationship. So let us begin with the transaction demand for money. How to plot all types of demand for money, and then come to the equilibrium conditions. So why we got and under which conditions that we got MS by P equals to L I R. So this is transaction demand for money, and say transaction demand for money will be upward sloping, like as income increases transaction will go up, and vice versa, like as transaction demand for money will increase or transaction for goods and services increases, then overall output will be increased. So now for making this discussion little simple, we are keeping precautionary demand for money, which is constant. We are keeping that out from this particular discussion. We are just dealing with two dynamics here. One is transaction, where income is becoming very dynamic and changing over time because it is depending on the transaction. The other dynamic variable here that we are talking about here is the I is the rate of interest, which is the direct interventions through the monetary policy. From the policy's point of view, if we talk about it. So now along with the vertical axis, parallelly, like to what we had shown in A, it is transaction demand for money, and then on the horizontal axis it is speculative demand for money. So just this is a trade-off, like overall total money supply will be fixed, as we said, like say overall total money supply will be fixed between two demand that is coming from the money market. One is transaction purposes and the other one is speculative purposes. So if speculative purposes, it is the money demand is becoming more, then for transaction purposes will be less, because overall money supply is fixed. So similar, if we establish this trade-off relationship between transaction demand for money and speculative demand for money, we can draw that can be reflected with this particular straight line, which is downward sloping, and here we are saying that this is what the total money supply will be distributed between two prominent purposes. One is for the transaction and one is for the demand. So in panel B, on the vertical axis, like where transaction demand for money that we are showing, so this transaction demand for money is depending on income, and this speculative demand for money, which we are measuring along with the horizontal axis in panel B, is depending on the rate of interest. So this particular this transaction and this transaction of money demand will be depending on these two dynamic variable. One is Y and one is I. So let's move to the next panel, which is say panel C. So here we are trying to plot the relationship between rate of interest and speculative demand for money. The amount of speculative demand for money that we have, we are actually keeping it here. And as we know that this is again depending on the market and rate of interest, and then demand for money is negatively related. So here is like say liquidity equation, which is like the function of the rate of interest. So this is panel C. Now if we bring all this all the different functional relationship in the money market, if we combine this in the overall money market and to fit them here in the overall money market, what is the curve that we will be getting it to represent money market. So let's again assume, like say Y1 is here, along with Y1, T1, the total overall transaction demand for money is there, and then here is T1, and here S1 for the speculative demand for money will be used. So because there is a trade-off between S and T, and here like with small I1, with OI1 amount of rate of interest, we actually OS1 amount of speculative demand will be demanded in the money market. So along with this rate of interest, we get one point. If we plot that, we get, say again, small e1 here. So with OY1 amount of income, we can transact for the transactional purposes for the goods and services OT1 amount, and with OT1 amount we have OS1 amount of money for the transaction purposes, for the speculative purposes, and with this OS1 amount of speculative money that we are actually using it in the money market at the rate of OI1 amount of rate of interest. So we got E1. So likewise, if income increases from Y1 to Y2, the transaction certainly will increase, and then here if transaction increase, then speculative money demand for speculative purposes will decrease because there is a trade-off, and if speculative demand for money will be reduced, means demand for money is becoming costly, so value of the money will be costly, and therefore rate of interest will be going up, like say I2. So here the inverse relationship between speculative demand for money and rate of interest. With the higher rate of interest, that we get, with the higher level of output, we get higher rate of interest. So if we combine these two, if we plot this, then we get LM curve. So LM equation, like LM curve, combining small e1 and small e2 with higher level of output and higher level of rate of interest. So this is in brief that I'm just reiterating that how LM curve looks like from the LM equation. So so here we have money supply and money demand, and money supply we plotted here in panel B, which is fixed, but then it is spreading across for the transaction demand for money and speculative demand for money, right? So the overall here LM equation is basically the equilibrium conditions. So here L Y I equals to MS by P. So this is what we call LM market equations, right? So moving forward, so what is the equilibrium? So money market cannot work in isolation, neither ICE curve can work in isolation as far as market is concerned. So intersection of the ICE and LM curve represents the simultaneous equilibrium in the market for goods and services for the transaction purposes, of course, in the market for all real money balance for given values of the government spending, like G, taxes, T, and then money supply, like overall fixed money supply, like MS by P, and its price level. So this is what we are going to discuss now. So now equilibrium here, like say rate of interest from ICE curve, we got from ICE curve we got the equilibrium market between two broad macroeconomic indicators. One is rate of interest and income. From the IS curve also, for LM curve also shows the for the functional relationship between rate of interest and the output. So IS curve is downward sloping and LM curve is upward sloping, that we already had drawn, and then they are intersecting at say point E, and at E is OI star is the equilibrium amount of rate of interest that will be charged in the market for producing OY star amount of the total output. So this is equilibrium conditions in the LM market. So what happens in the fiscal policy and then IS curve? So let us take just only one example, and then there could be many combinations of the policy changes, and then we can actually see how it goes, right? So but then we'll take only one, and then others can be viewed as through the different practice sets or different practice questions. So changes in the government purchase, and here as we know that fiscal policy is basically can be introduced through two major components. One is government expenditures and then tax. Tax means directly through consumptions, because disposable income includes the tax. So that is where the relationship between tax and then total output, and precisely this is negative, because if tax increases, output will be reduced, because if tax increases, then disposable income will be reduced, because consumption purpose after consumption, after the tax, the consumption will be reduced. So that way we actually can think of fiscal policy and its relations. So if changes in the government purchase, like increase in the planned expenditure, stimulates production of goods and services, which causes the total income Y to rise. So here for instance, here we can draw here like say income and then rate of interest. So IS curve here, initial IS curve here, and then due to changes in the government expenditure. So now government expenditure, like say G is getting increased. So as we know, G and Y are positively related. So if G increases, then Y also will be increased, and therefore IS curve will shift rightward, and then it will go upward, and then this is LM curve. LM curve is the upward sloping. So sloping, but then IS curve will shift rightward. So here if you see income at the initial level, like at say at E1 level, we have OY1 amount of output and OR1 amount of rate of interest. With expansionary fiscal policy, IS curve shifts rightwards, and then we get the new equilibrium point between IS2 and LM, and then we get new equilibrium point E2, which means we have higher output, but then at the same time rate of interest also will go up. So this is what the situation when simultaneous equilibrium is happening, considering fiscal and monetary policy. But then in this particular case, when government expenditure increase. So this particular changes between IS1 and IS2 is due to changes in the government expenditure, right? So now in the case of taxation, like similarly, like if we if tax increases, then output will be reduces. Why? This is in this case, particularly this case number 2, because this is like consumption function, like as you know, is A plus B YD, and BYD YD is basically nothing Y minus T. So obviously consumption and output, they are positively related. As consumption increases, output will be increased as well. Like if output increases, then of course consumption will also increase. So if tax increases, then consumption falls, and overall output, it will reflect in the output where it will be reduced. So if tax increases, then certainly there will be reduction in the output. if tax reduces, if T is less. So likewise, if T is less, then Y will be more. So when we talk about expansionary fiscal policy in this particular case, here we are talking about tax cut, which encourages consumers to spend more and therefore increases planned expenditure, which is output, right? So now let's draw quickly I, and here Y, and here LM, here IS1, and due to tax cut, overall Y will be there, IS curve will shift again rightward, and likewise, just like in the above case, income will also increased from, and rate of interest also will increased. So this is what this is the case of the expansionary fiscal policy. So now let's move. So in this particular case, I think we are very clear because government expenditure and tax are the policy interventions, and here the policy interventions that we are talking about is the expansionary fiscal policy context that we have seen, that how it changes in the equilibrium level, means what are the repercussions of this expansionary fiscal policy in the market and economy, overall economy as a whole. So now monetary policy changes in the money supply. Let's increase an increase in the money supply lowers the rate of interest, which stimulates investment and thereby expands the demand for money and services, right? So so IS curve like will be fixed, and here rate of interest this is LM curve. So with the expansionary monetary policy, money supply will be more, and therefore LM curve will be shifting rightward, LM1 to LM2, and we can see here. So at the first, and then later output will be increased, but then rate of interest will be decreased. So this is what we call monetary policy interventions in and if expansionary monetary policy, then rate of interest will be reduced and money supply, more money will be injected in the market. As a result, output in the market will be more and rate of interest will be less. So now let's move to further, because this is very important, and we already discussed this crowding out and crowding in context of investment and savings. So let us also discuss here with the help of IS and LM. So rate of interest and here income. So as we know, IS curve, like say IS1 is a representations of the product market or fiscal market, and then LM1 is representing the equilibrium conditions of money market. So here the first equilibrium point through along with this OY1 and then I1, and then suppose government expenditure increases like through expansionary fiscal policy, like then we know that through expansionary fiscal policy IS curve shifts upward, and then this shifting is because of changes in the government expenditures, and we can see here clearly that rate of interest is increasing, output has increased, and rate of interest also has increased. So now new equilibrium that we get it from A to B. So now from B at B rate of interest is high and rate of overall output also is high, but then there are two possibilities here. So this higher rate of interest will actually discourage the private investor to retain, to stay back in the market, and therefore they will try to move out because of government is actually spending more, and therefore rate of interest has increased, and then output will get reduced to Y3 because Y1 and Y3 amount is getting crowding out, because private investors will be very much discouraged. So here see, but then just imagine OI1 amount of rate of interest. If money market doesn't respond that way, and money market say rate of interest will be keeping at the fixed rate like OI0, then output will be increased from Y2 to Y4. So of course Y2, Y1 to Y2, then Y2 to Y4 is basically crowding in conditions. So here say another one point is a D. So point D is crowding in conditions, and is point C is the crowding out conditions. So when economy is very weak and government wants to encourage more and more investors, then definitely rate of interest has to be fixed at very low rate, which is OI1, and then we can see that with keeping lowering the rate of interest, total output will be increased. If economy is strong, and then also government wants to play as a single monopolies, then to move private player out of the market, then simple way is doing that rate of interest goes up for the borrowing, and so that private investors or the producers will be out. So this crowding out and crowding in are very important discussions, especially public policy framework. And here fiscal policy, while framing the fiscal policy or framing monetary policy, this crowding out and crowding in concept are generally kept in mind in the policy makers mind. So now I'll stop here, and then these are the two references that I have used for this particular lecture. So for more details and more examples, you are free to read these two books, and then I stop here, and thank you very much for your attention, and I'll see you in my next class.